Hello friends, welcome to lecture series on financial management. Myself Aditya P. Tripathi, I am once again with you to continue our discussion on to the IRR, that is internal rate of return. In the previous lecture of mine, I told you how to deal with the abnormal cash inflows, where we tried to understand how to calculate IRR when the cash inflow is abnormal. And there we computed NPV and IRR in the same problem, and the answer was not identical, the decision was not identical. One particular method, that is NPV, was suggesting was going in favor of say project X, and the other was going into the project Y or B, you can say. So both the methods were giving two different results. Now the question comes into our mind that which method to rely upon, whether we should go with the decision given by NPV or we should go by IRR, because both belong to the category of modern techniques and both are time adjusted techniques. So it means that on which value to rely. Obviously we should, in such situation, we should rely on to the value given by the decision given by NPV. I'll be telling you in today's lecture why we should rely on to the data given by NPV, the decision given by NPV, and not the IRR. Or even if I have to go with the IRR, what kind of modifications required into the computation of internal rate of return. So that would actually be the focus of today's lecture, in which I'll be telling you how to deal with the this situation when the two important techniques of capital budgeting, NPV and IRR, they do not give you the identical results, rather they are giving you the conflicting results. But before we go for understanding that when can they give you conflicting results, we should understand that what are the compositions which actually make it possible that both the methods are giving us the same decision, or you can say the identical decision. So the conditions when this method is going to give you the conflicting or identical results, we have to understand that as long as the appropriate discount rate is used, the NPV technique will always provide you the correct ranking. So if your rate of discounting is proper, whatever rate of discounting we have chosen for computation of NPV, if that is going to be appropriate, this NPV technique is going to provide you the correct ranking. However, it is the IRR technique in which we have a possibility of producing incorrect ranking while evaluating the mutually exclusive proposals. Cause into IRR, the question comes why there is a possibility of this kind of incorrect ranking, or you can say conflicting results when it comes to the computation of IRR in a mutually exclusive proposal. The reason for this is this is manifold, or you can say there are 2-3 possible reasons. There are 2-3 possibilities where your this particular IRR is going to be a conflicting is going to give you a conflicting results in relation to that of NPV. So the first very reason which is reported here is the scale or size disparity. Suppose if we are going to deal with a project where the size or the scale of this particular project is entirely different. I'm going to evaluate two proposals, and both the proposals are quite different in terms of their size. So there can be a conflict in ranking due to the size disparity among projects. And when the size disparity is there, the question comes, what is the role of size? It actually comes from the very basic nature of these two methods. If you look at the NPV technique, what we do, we calculate net present value. We are taking the benefit and cost of the proposal, we are taking the present value of cash inflow and present value of cash outflow, and these two cost and benefits are compared to arrive at net present value. So when I am saying that net present value, it is actually giving you the absolute value of benefit. It is telling you that out of this project, if you are taking up this project, it is going to give you this much of absolute net benefit, cause the difference of NPV is present value of cash inflow minus present value of cash outflow. So the differential value, if it is positive, it is going to tell you about the net benefit out of this project. So into NPV, what we are doing, we are dealing with the absolute benefit, and in this particular method, we are not bothered about the relative value. We are talking about the absolute net benefit, and it is going to be affected by the size of the proposal. If I am talking about the absolute net benefit, obviously it is going to be affected by the size of the proposal. Remember, higher the cash outflow, higher the size of the project, greater would be your expected returns. Suppose you are investing into a project which is costing very high. Obviously, your expectations in terms of cash inflow will also be very high. Because we are investing this much of amount, this investment is very huge. That is why I want that the benefit should also be very huge. And since we are talking about the absolute terms, the ranking is obviously going to be on the higher side when I am dealing with the NPV method, that is net present value method. So remember, NPV is going to, what we do into NPV? Into NPV, we are supposed to deal with the absolute benefit. Whatever the absolute benefit the project is giving to us, that we are going to consider, and that is why if the size of investment is high, obviously in relation to that, in proportion to that, your cash inflow is also supposed to be high, on the higher side, and that is why your ranking will also be on the higher side. Whereas in case of IRR, what we do, it is entirely opposite to that of NPV. We are dealing with the relative returns, that is in terms of percentage. We are not giving you the absolute value. Whatever is the outcome out of computation of IRR, that is in terms of percentage. So it means it is ignoring the size of the proposal. When we are dealing with the IRR method, when we are solving a numerical via IRR, what we are doing, we are ignoring the size of the proposal unknowingly, because we are not concerned with the size of the proposal. Rather, we are concerned with the effective rate of that return which the project is going to give, which the project is supposed to provide. So we have to understand it is the very basic nature of these two methods which forces to provide, which forces them to provide the contradictory results if there is a size disparity, if there is a disparity in terms of scale of that particular proposal. For instance, if all the cash inflows of a project are doubled, suppose we had a problem, we had a numerical problem, and we are going to double all the cash flows of a project, what will happen? Their NPV will also double. Because since we are doubling all the values, the resultant value, that is NPV, is also going to be double, and that will actually give us the greater absolute net benefit, or you can say net present value. So we shall be relying on to, and into NPV what we do, we are going to rely on to a project which is giving us the highest positive NPV. So if you are doubling the cash inflows, your decision is going to change, because your NPV is going to get double. Whereas in case of IRR, even if you are doubling the value, doubling the cash flow, you change the cash flow, you increase the cash flows, what happens? Your IRR remains unchanged, because it is dealing with the relative returns. The rate of return remains the same. Even if you double, the rate of returns remains the same, because the relationship between the two factors, that is your cash inflow and cash outflow, remains the same. And since we are dealing with the relative returns, that is in terms of percentage, your IRR will not change. So remember, this is the one possible reason for IRR and NPV giving a conflicting result. What if there is no scale disparity, there is no size disparity? Both the methods are going to give you the same or identical decisions. Whatever NPV will suggest, whichever project NPV is going to suggest, the same would be suggested by IRR if there is no scale or size disparity into your proposal. But what if there is a disparity? Obviously they are going to give you the conflicting results. Let's understand this particular disparity with a small example. Suppose there are two projects A and B. The cost of project A is 10,000 rupees, cost of project B is 30,000 rupees. Now here is a scale disparity. If you look at the cost involved into project B, it is 3 times the project A. In case of project A, it is 10,000 rupees. In case of project B, it becomes rupees 13,000. If you look at the cash inflow, what is happening? 5,000 rupees in first year, second year 6,000 rupees, third year 4,000 rupees for project A, and for project B it is 14,000 rupees, 19,000 rupees and 10,000 rupees. What is the minimum required rate of return here? 10%. And you are asked to evaluate these two proposals as per NPV and IRR. So to cut short the story, I'll only be giving you the answer of these two methods, so that you can understand that when the size disparity is there, what would be the result of, what would be the decision as per NPV and IRR. If you look at the comparison of results, when you will be computing NPV at 10% rate of return, the NPV of project A will come to be 2,509, whereas that of project B is going to be 5,942. Remember, if you can recall, just before this example I told you, if we are going to double the cash flows, what will happen? the absolute net benefit is going to increase, or NPV is going to increase, and since we are dealing with the absolute net benefit into NPV, that is why we shall be selecting a project which is giving us a higher positive NPV. So here in this particular situation, project B is going to be selected. As far as our decision is concerned, we would say that we should go in favor of project B, and since we already had an assumption that there is no capital rationing, there is no shortage of funds, because at times my students come to me and they ask, sir, in one project the cost is 10,000 rupees, in project B the cost is 30,000 rupees. So don't you think that it would be better if we go as per economy model of this particular project, because project A is giving us the costing us rupees 10,000, although it is giving us the lesser NPV. But my dear students, with the given assumption, NPV suggests that we are dealing with the absolute net benefit, and that is high in case of project B. So the decision will go in favor of project B as far as NPV is concerned. Whereas when we will calculate IRR, the rate will come to be 24.3% and 21.5%. And if we go as per IRR, the desired rate is greater in case of project A, so the decision will go in favor of project A. Now you are in a dilemma. You are in a complete state of dilemma that which method to rely upon. Both are modern techniques. NPV is saying take project B, and IRR is saying take project A. Obviously, we have to recall the very basic objective of our financial management, that we have to maximize the wealth. And wealth is only maximized in case of NPV, where we get the absolute net benefit. So that is why we have to take up project B, because wealth is maximized here only. In case of, if you are going as per IRR, you are not maximizing your wealth. Your wealth is maximized when you are making use of project B, because it is giving you the maximum absolute net benefit. And remember, while giving your remark, you have to give this decision that both the methods are giving us conflicting results, and reason you will have to identify. And here the reason is the scale or size disparity. But your decision should go in favor of wealth maximization. So you would say that, having this assumption that there is no capital shortage, we would go, our decision will go in favor of project B, because it is actually ensuring the wealth maximization of the firm, that is by project B, because it is giving us the maximum NPV. So in this way, we have understood what will happen if there is a scale or size disparity, in case of NPV and IRR. Remember, whenever this situation is there, what will happen? NPV and IRR will give you conflicting result. The question comes, what can be the other possible reason? The second possible reason can be time disparity. The first was scale disparity, the second is time disparity. Now when we talk about time disparity, time means in terms of receipt of cash inflow. There may be a conflicting result by NPV and IRR even when the proposal involves the same outlay. Suppose the cost is the same, but there is a different timing of cash inflows. So cause of change in the time of cash inflows of both the projects, what will happen? Your NPV and IRR will not give you the identical decision or the identical results. And it happens when the larger cash inflows from one project occurs during earlier period of its life. So there is a project and the larger cash inflow from this project is received during early period of its life. But in the competitive project, what is happening? It is opposite to that. Larger cash inflows are received at the later stage. So this will happen, this situation will arise when you are dealing with two proposals, and in one, what is happening? You are receiving larger cash inflow initially, whereas in case of the second one, what is happening? You are receiving the larger cash inflows at later stage. If this type of situation is there also, your NPV and IRR is not going to give you identical result. So what will happen? Let's see with a very small example. Suppose there are two projects, one is costing 2,500 and project B is costing 3,000 rupees. So there is not much disparity in terms of scale or size. There is only a slight difference in terms of cost. One is costing 2,500 and the other is costing 3,000 rupees. But if you look at the the pattern of cash inflow, what is happening? In case of project A, initially the amount received in terms of cash inflow is greater, whereas in case of project B, it is opposite. Initially the amount is less and later on it is increasing gradually. Minimum rate of return is 8% and you have to evaluate these two proposals as per NPV and IRR. Before solving, I am telling you this proposal is going to give you a conflicting results in terms of NPV and IRR. Whatever decision you will take, this is going to give you the conflicting results. So let's see what will be the answer. When we will be calculating NPV at 8%, the value of NPV for project A will be rupees 606 and that of project B will be rupees 702. If we go as per NPV, we have to take the highest positive NPV. So we shall take a decision or make a decision that we should go ahead with the project B. Whereas if we go as per IRR, what will happen? The rate is going in favor of project A because it is on the higher side. Both the rates are greater than required rate of return, that is 8%. But since IRR is greater in case of project A, that is 24.8%, we should take a decision for project A. The question comes now, what to do? One method is saying take project A, the other is saying take project B. Remember, this disparity is arising cause of change in time pattern, or you can say time disparity. So due to time disparity of cash inflow, what is happening? We are actually bound to go by the concept of wealth maximization. So we would again say that NPV should be relied upon and we should go ahead with the project B because it is increasing our the wealth of shareholders. We are maximizing the wealth because the absolute benefit is greater in case of NPV. Whereas IRR is only giving me the relative returns, that is in terms of percentage. So we have to understand that we have to rely on to the decision given by NPV. So in this way, my dear students, these two can be possible reasons. There is another reason also which I will be discussing in due course of our lecture today. The first was the scale disparity. So whenever there is a scale disparity or size disparity of two proposals under evaluation, your NPV and IRR will not give you identical results. And the same will happen when there is a time disparity in terms of receipt of cash inflow. There also it will happen. Now the question comes that at times we are facing a situation where we have to go for a reinvestment rate assumption. We make an assumption that the cash inflow can also be invested. So the NPV techniques into this particular assumption, what it does, it assumes that all the intermediate cash inflows are reinvested at a rate which is equal to the rate of discounting. So we make an assumption that into NPV, whatever intermediate cash inflows we will be receiving, that would be reinvested at a rate which is equal to rate of discounting. So whatever discounting rate is there, on the same rate will be compounding the present value of cash inflow. Whereas if you go to IRR, their assumption is that if we have to go for reinvesting the cash inflows or the intermediate cash inflows, the rate of investment will be IRR only. And here comes the difference. Here comes the point of difference. The point of difference is the rate which you are going to use for a reinvestment pattern. Suppose there is a problem in which the examiner is asking you or telling you that the firm has an option of reinvesting the cash inflows at so and so rate. So at that rate you are going to reinvest. Into NPV, what will happen? You will be investing it at the desired rate of discounting, whereas in case of IRR, you will be reinvesting into IRR only. And both the rates are going to be different. So that is why there would be a ranking conflict. The conflict in ranking of mutually exclusive project arises due to different investment rate assumption of the two techniques. So this is also a reason if the firm is having reinvestment assumption into NPV and IRR, this can also be a reason for the ranking conflict which may come across. And in order to overcome this conflicting situation of NPV and IRR, basically what we do, we modify the IRR to make it consistent with the NPV method. And that is popularly known as MIRR, that is modified internal rate of return, which means we will have to modify our internal rate of return which we are normally calculating if there is a reinvestment assumption into your particular numerical problem. We have to understand that NPV is going to assume that whatever reinvestment is done, that is done at a rate which is my rate of discounting. Whereas in case of IRR, what we assume that reinvestment is done at the IRR rate itself, that is internal rate of return itself. Now let's understand another reason for this particular conflicting results, that is life disparity. In a mutually exclusive proposals, we make an assumption that all the projects have equal lives. If you remember, I told you while discussing the concept of NPV that when the life of two projects are not similar, we can't go ahead with the NPV in a normal manner. We'll have to modify our NPV, and there I told you about the concept of equivalent annuity method along with other methods of modification. So there we went for computing equivalent annuity in order to make both the values at par with, so that we could take our decision. So here this disparity is going to give you a different result. If there is a life disparity, obviously NPV and IRR is going to give you a conflicting result. And if it is not so, what will happen? There is a modification required in NPV, and we have already understood into the concept of NPV when I was discussing how to calculate equivalent annuity or the present value of equivalent perpetuity. That we already discussed, that how to deal with the unequal life of the proposal, and there I told you that this can be a reason for the difference in the decision given by the NPV and IRR. Now at the fag end of the IRR, that is internal rate of return, it is my duty to tell you another method into NPV, that is called terminal value method, where the question is not only asking you to calculate NPV but also giving you a reinvestment option. It is basically a variant of NPV method, and in this method what we assume that the future stream of cash inflows are first compounded at the expected rate of interest. Now what is the period of investment? The period will be from their occurrence till the end of the economic life of the project. Suppose if the cash inflow is received in first year and the project is having a life of 4 years, so that amount is going to be invested for 3 years. And in second year what will happen? That is going to be invested for 2 years, and last value will not be invested at all because that amount is going to be received at the end of that particular project or the life of the project. And what we do after computing the total compound value, we actually give it a name of terminal value, because that will be the present value of the compounded value of all cash inflows, and the total terminal value is then discounted at whatever rate given in the question to calculate present value, and afterwards the rest of the process remains the same as we have been calculating NPV, present value of cash inflow minus present value of cash outflow. The only addition here is that you have an option to reinvest your particular cash inflow what you are receiving, and the same is reinvested, and after that you calculate the present value of that cash inflow. Let's understand it with a very small example. Cost of a project is rupees 2 lakh, expected cash inflow is rupees 60,000 per annum for the next 5 years. Cost of capital given in the question is 12%. The firm has an opportunity to reinvest the funds is at 10% per annum, and you have to calculate NPV. So here you have to understand, normally what we have been doing, we have been computing the present value of cash inflow, but here we will have to first compound all the values. All cash inflows are uniform, 60,000 rupees per annum. Compound value factor will be 10%. You must be thinking how to refer to the table. The value is in descending order. So there might be a doubt into your mind that sir, table doesn't go like this. In table you never find a value of 1.00 which is written in the column of, in the row of 5th year. Remember my dear student, this amount is not going to be invested. So we have to find out, we have to observe, we have to take the values from the table and understand that which amount is going to be invested for how much time. First amount of 60,000 rupees is going to be invested for 4 years. So when you will be referring to CVF table at 10%, you will take the value of 4th year, and that comes to be 1.464. For second value, you will take the value for how many years? Second year you are receiving, so third, fourth, fifth. For 3 years the value becomes 1.331, and in this way we take all the compound value factors from the table, and for last year it is not going to be invested, so 60,000 rupees will remain 60,000 rupees. After computing this compounded value, we can give it a name of total compounded value, or you can call terminal value, which becomes rupees 3,66,300. And now it's time for us to calculate the present value of cash inflow. You can discount it. Rate of discounting given in the question is 12% for 5 years, and you get a present value of cash inflow of 2,07,692. Present value of cash outflow given in the question is rupees 2 lakh, and you calculate NPV, the NPV becomes rupees 7,692. So my dear students, in this terminal value method, what I wanted to suggest that whenever the question is giving you an option to reinvest, that there is a rate on which you can reinvest your cash inflows. In this way you will be computing NPV. Why I am telling you about this concept when I am discussing IRR, and that too the conflicting results of NPV and IRR, because this is a possible reason also, because at times you have the reinvestment rate assumption, and that reinvestment rate assumption, the rate which we are assuming here is different in case of NPV and IRR. So in this way NPV so calculated and IRR so calculated is going to give you a conflicting results. That's why I thought that it would be appropriate for us to understand this terminal value method here at this point when we are talking about the conflicting results of NPV and IRR. So in examination at times we ask you that what can be the possible reasons for NPV and IRR giving a conflicting results. So I told you about the scale disparity, I told you about the time disparity, I told you about the life disparity, and then eventually I told you about the reinvestment rate assumption. So these four are the possible reasons cause of which the NPV and IRR are not going to give you the identical results. And what will prevail there? Which decision will prevail? Which decision would be widely accepted? The decision which is given by NPV. And here comes the end of IRR. But before ending this particular topic of IRR, it is my duty to tell you how to modify this IRR by computing MIRR, that is modified internal rate of return. At least you should understand that what are the steps into the computation of MIRR, that is modified internal rate of return. As I told you that why this modification is required into IRR. We are trying to give a solution to this kind of disparity. Suppose if they are giving you the different decisions, one way is that you go as per your discretion, and obviously the discretion says, the rationale says, you can say the very need of the business says that you have to maximize the wealth of the firm. And since you have to maximize the wealth of your firm, you have to understand that for maximization of wealth, absolute net benefit is going to work. This relative value is not going to work. That is why NPV is still regarded as one of the most important or one of the most acceptable techniques of capital budgeting. So while taking a decision, these can be the possible reasons for disparity, and if you wish to deal with this disparity, there are two ways. One is that you go ahead with the decision given by NPV, and the second is you calculate MIRR, that is you modify your internal rate of return. And now what are the steps for calculating MIRR? There are two steps. In step 1, we calculate single terminal value of all net cash flows, making an assumption that reinvestment rate to be the cost of capital used under NPV. So we make an assumption that whatever cost of capital is used into NPV, at the same rate we will be calculating the terminal value. And in step 2, what we do, we calculate MIRR with the help of present value of cash outflow and the terminal value which we have calculated with the rate of discounting which is used into NPV. Since both the rates are similar, we can understand it with a very small example. There is a company where project is costing rupees 20,000, life is 5 years, cash inflows are reported, and we have to calculate MIRR. So first we will be calculating what? Terminal cash inflow, or you can say compounded value, which comes to be rupees 39,112, and present value of terminal cash inflow will be calculated at 10%. Present value becomes rupees 24,288.5. Cash inflow, present value of cash outflow is rupees 20,000, and NPV becomes 4289. We can calculate MIRR with a functional formula where present value of cost or cash outflow is equal to terminal value divided by 1 plus MIRR to the power 5, because the life here is 5. And when we calculate, we will be getting the MIRR to be 14.35%, whereas normally IRR would have come to be 17.15%. So in this way, my dear students, we try to understand all the techniques of capital budgeting, that is traditional as well as modern techniques. I hope you must have understood and enjoyed this particular topic of capital budgeting. Thank you so much.